Welcome to this Discovery podcast. Harry Joffe is the head of legal services at Discovery, and Harry Joffe is here to educate us about the law of the land when it comes to money and how you manage your money. And unfortunately, Harry, it's not as simple as simply getting a financial advice and getting a financial plan. The law also has a considerable impact on our decision making when it comes to how we treat our assets.
Yeah, Bruce. I mean, you got so many things you got to think about. You got to think about estate planning. You got to think about tax. You got to think about other legal issues. So, I mean, estate planning and tax are probably the two most important. But it's not just that. I mean, you've got to think about, as we've discussed previously, your different investment choices, your different jurisdictions. But I think for our purposes, we've only got half an hour. We'll focus on tax and estate planning. Might be easier.
It most certainly will be. Thank you for narrowing it down a little bit. I mean, broadly speaking, South Africa tax and estate planning 101. What are the big issues we need to look out for?
Right, so let's start with estate planning. So South Africa is similar to the UK in the sense that it allows for what we call freedom of testation. And that means you're quite free when you die to leave your assets to anyone you want. There are obviously a few exceptions. You have to maintain your spouse and children, and there are maintenance obligations. But that aside, you can leave your assets to your best friend and cut out your family if you so choose. Whereas if you look at Europe and some other countries like that, where they've got forced heirship, you don't have freedom of testation. So that's a plus, but of course it makes it more tricky because now you've got to think about a will. You've got to think about who gets what in your will. And you've got to actually sit down and do that. And Bruce, South Africans hate doing wills. I mean, I think something like 60 to 70% of South Africans die without a will. It's actually amazing. And then you've got, of course, a whole different set of complexities that arise. But you've actually got to sit down and you've got to look at yourself, you've got to look at your assets, and you've got to do a will or get a will done for you by a professional. And you've got to decide who gets what and how to distribute what. So that's kind of at the end. And then, of course, South Africa applies an estate duty. So you do pay duties on your assets when you die, which is on top of income tax. And our estate duties are actually quite simple. It's a 20% or a 25%, depending on the size of your estate. So part of estate planning is not just doing a will and making sure the right people get the right assets, but it's trying to plan legitimately to try and minimize your estate duty exposure, which you can do quite legally.
Okay, lots to talk about in that particular front. When we look at the fundamental issue of estate planning and retirement planning and life insurance and the taxes involved, how does the smorgasbord of complexity work together?
Yeah, Bruce. I mean, so that's where you need your advisors and your advice comes in because, I mean, you could very well jump out of one tax and land in another. So I'll give you a classic example. So for estate duty, you're obviously trying to minimize the value of your assets. So you've got a business for estate duty. When you die, the shares in that business are subject to estate duty, like all your other assets. So what all good South Africans do, although they shouldn't, they try and undervalue their business value for estate duty. But then, of course, on the other side of the equation, you've got tax and you've got capital gains tax. And then you need to, in your tax returns, you need to value that business for capital gains tax. And South Africans, because they might sell that business, they want to have a lower capital gain when they sell the business. So they might overvalue the business for capital gains purposes. Now, of course, that catches you. So if you overvalue for capital gains purposes, so one day when you sell it, you don't have a huge capital gain, but then you don't plan carefully and you die in the middle, then you've got an increased value for estate duty. So you're kind of going to get caught in one of the taxes. And I always say to clients, you might not like this, but you must actually try and be honest in how you value your assets. Because whichever way you go, if you're dishonest, you're going to get caught to one of the taxes. And capital gains tax is such a clever tax because it's there to catch you when you try to do these funny things. Because it's a tax on capital values, it has so many other consequences. So you try and move assets out of your estate to avoid estate duty, but because you're giving up ownership of an asset, that triggers capital gains tax. And that's why, Bruce, you can't look at tax planning and estate planning in isolation. as you put it so nicely, you've got to look at the smorgasbord. You've got to look at everything together and try and plan to minimize your overall taxes, not just try and avoid one.
Why is it that South Africans think they are so incredibly smart and that they can outsmart a tax authority that has met many, many people far wilier, far sneakier, far more deceitful than they could ever imagine to be? I mean, it just strikes me that we're quite naive sometimes in dealing with our tax authorities. We think that we're smarter than they are, and I think they wake up before we even, they have breakfast long before we even think of waking up.
Yeah, Bruce, I mean, that's true because our tax authorities, and this is a scary thing, which we don't always realize, that tax authorities around the world meet and chat and discuss cases and discuss tactics. So, our local revenue officials, they used to when they could travel, they go to all these multilateral meetings at the IMF and with all the other revenue authorities. And now with the CRS, the Common Reporting Standard, which is around the world, where all revenue authorities around the world share information, it's even worse. So, if you've got a clever structure in the UK, which has been stopped, you'll find very often our authorities here will simply copy that. And, capital gains tax is a classic example. We copied a lot of the law from overseas. We brought in our Capital Gains Act or schedule because they've had it there for so much longer.
So you say tax, and even the hardy-dars get scared. When it comes to taxes on estates, who's responsible for those payments?
Okay, great. So the hardy-dars have gone silent, so I can quickly talk before they get nervous. And it's an interesting question, Bruce. So when you look at estate duty in a deceased estate, it's not a simple answer. I mean, nothing is simple when it comes to estate planning and estate duty. So there's different permutations. So all the physical assets, so shares, houses, physical assets in the estate pays that estate duty, and of course the executor pays it for the estate. But if you've got other assets, you've got, for example, a life insurance policy, which let's say pays to a child of yours, we'll keep it simple. So dad dies, his life policy pays to his son. That policy is actually still estate dutiable in dad's estate because the Estate Duty Act deems it to be an asset in the estate because it was on dad's life. And now you've got an interesting mismatch. You've got dad's estate having to pay the estate duty. You've got the son sitting with the money from the policy. And then in terms of the Estate Duty Act, the executor will recover that estate duty from the son. So when you've got life insurance policies, the beneficiary of the policy will have to refund their estate duty and in effect pay it, although the estate pays it. So again, there are different permutations depending on the assets. Life policies are different to actual physical assets because they're the deeming provisions which catch them.
Why does it have to be so blimmin' complicated? You would have thought that, after 30,000 years of human evolution, from the days where, if the woolly mammoth got us, then whoever was oldest in the cave got the cave. We understood the way things worked, 30,000 years ago. Why has this world of inheritance and estate duty and taxation become so complicated?
Yeah, I think, Bruce, it's just that life has got so complicated. So in the good old days, you just used to have your cave and you used to have your Liverpool shirt, and those are your two assets.
No, well, one's an asset and one, is a potential future liability, but carry on.
Or a growth asset. Yeah, so life was very simple. Now, of course, you've got so many different kinds of assets. You've got life policies. You've got cryptocurrencies. You can't believe the assets clients have and how complicated it gets. We had a client a while ago who had a SARCAD collection. So he had a nursery. He had a SARCAD collection worth 10 million Rand in his nursery. Now, think how complicated that gets for estate planning, because now he's got to think about, if he dies, who takes over those SARCADs, and his kids are not interested in nature at all, so they wouldn't water the SARCADs. The SARCADs could die, and 10 million Rand could disappear overnight. So part of his estate planning was trying to work around these SARCADs and who was going to look after the SARCADs. That's again not simple. Clients have got all these digital estates now. In America, the Americans, of course, are more neurotic than we are. They are now developing a concept of not only a normal executor who winds up your normal estate, but now you've got a digital executor who winds up your digital estate separately. And then he winds up your Facebook accounts, your Instagram accounts, all your digital stuff. And I mean, digital has made the world totally different because you need to try to plan around that. There was a very famous case last year where a Canadian entrepreneur started a cryptocurrency fund. He had about $100 million invested in this fund. He then took a nice holiday to India to go and discover himself. He unfortunately died in India, didn't leave the keys or the passwords to that fund to anyone, and now that $100 million is gone. No one can track it. So now we've got cryptocurrencies, we've got digital assets, clients have got wine collections, horse stud farms. I mean, life is just complicated. So these are not simple estates or things to wind up anymore. It's a whole team you often need. I mean, when you've got clients that die with horse farms, then the executive's got to manage that horse farm.
Rich people's problems. And I suppose if you've got a tax problem, then you've had extraordinary privilege and you should be lucky enough to have a tax problem and pay for the advice that you're going to need invariably to sort all of this out. If a beneficiary is a minor, and you made the point earlier of a minor, for example, as a recipient of a life insurance policy, but if a beneficiary is a minor, how do you minimize tax liabilities? Because the intention of the deceased is that the minor should get a leg up in life, or sometimes both legs up in life.
Right, Bruce. So let me tell you, you've hit a button here, because if there's one thing that upsets me, apart from people that wear Man United shirts, but if there's one other thing that upsets me is when, and I have this every month, is when someone dies and they nominate their minor as a direct beneficiary on their life policy. And that causes endless trouble because dad dies, he's got a policy of, say, 5 million rand. Now his minor is a beneficiary on that policy. And suddenly everything is a mess because if we were to pay 5 million rand to that minor's bank account, who's going to manage that money? The minor's guardian is going to get his greedy hands on that money. And we don't even know if the minor will ever see the money. And then we at the insurance company have to try and play Solomon and try and divide up and solve the problem where we pay the money to. We could pay it to the Guardians Fund in Pretoria, in which case it will sit there till the minor turns 18. Probably get
but here's the problem with that, is that that's not serving your client, and it's not serving your client's wishes, because that is not a place to be parking money, surely.
Yes, and so that's a problem. So we could pay it into the minor's bank account, and then the Guardian wastes it. Or we could try and help the minor to invest it, but then who makes a choice on behalf of the minor, and where does the money go, and who makes sure the money is protected? So the simple answer to that, Bruce, is instead of dad nominating the minor as a beneficiary directly with all those problems that it then causes, is rather nominate a trust as the beneficiary on the policy. Now you're going to say to me, well, that's all very well, but you know what it costs to set up a trust? It can cost quite a bit of money, and that's fine because you don't have to have the trust set up now. What you could do is you could nominate what we call, I'm going to throw in a fancy word again, as I love doing, you could nominate a testamentary trust to be the beneficiary. So in your will, you create a trust. In your policy beneficiary nomination, you use that will trust, that testamentary trust, and you make it the beneficiary of your policy. Then when dad dies, we all wait for the trust to be set up, and we can pay the money straight into the trust to be properly looked after for the benefit of the minor child.
That would be sensible. Okay, good guidance on that. But there are also cases where parents, with all the best intention in the world, set up and have a letter of wishes, have a will, have their kids nominated as beneficiaries in their wills, and then they don't look at the stuff again for a while. And it might be a year or 2 or 10. The kid is no longer a minor. The kid is a beneficiary of the estate. Yet dad and mum fell out 10 years ago, maybe got divorced. And suddenly there is a new person on the scene who challenges the veracity of the will and says, hold on a second, but he was going to leave it all to me. He was actually on his way to the lawyer's office to change his will or to change the beneficiaries of the policy. And suddenly the trustees of these big insurance companies are going to make big decisions as to where the money goes. I mean, just because you're nominated or you have nominees and you have it written in a will and you've written it in blood on a document somewhere, doesn't necessarily mean that your beneficiaries truly are your beneficiaries. And I came across a case like this in my extended family fairly recently, and it was something of a body blow to the kids who thought they were going to be inheriting a fairly substantial amount of money.
Yeah, Bruce. I mean, South Africans, they watch so many soap operas. They love to think that they can challenge a will. On TV, it's very easy. Just challenge the will, and it's simple. South African law is a bit more conservative. So our courts and our judges don't like overturning a will unless, of course, there's clear evidence of fraud or what we call undue duress. Now, it gets a bit more complicated because obviously you have to maintain your spouse and children. So, I mean, if you have a case where dad dies, he leaves his entire estate to the SPCA and he cuts out his wife and his children, they will lodge a maintenance claim and they can challenge that in terms of maintenance laws. But that's a bit different to challenging the actual veracity of the will. I mean, we had a great case a couple of months ago. We had an individual who had a first wife who he had divorced. He had a girlfriend who was now almost his second wife, but then he got tired of her and he had a third girlfriend now. And then he goes into hospital. He had a brain tumor, goes into hospital, and then he took up with the nurse. So he's got like a fourth lady on the scene. And then he wanted to change the beneficiary on his life policy from wife 1 and girlfriend 2 to nurse 4. And it really gets complicated because now what do we do at the insurance company? We don't want to start getting involved in his personal affairs, but we don't want to let the law get broken. And we had to take a difficult call. But eventually, he agreed to make a trust the beneficiary on that policy for his kids and not any of the 4 wives. So we were kind of happy with that. But it gets very difficult. People have got complicated lives. They change, circumstances change. I can't tell you, Bruce, how many people in their wills have got ex-spouses still as heirs who they've forgotten to remove. We had a case a couple of weeks ago where a widow had her deceased husband still as an heir in her will, which is also a mess. So, I mean, it's really important. I agree with you, Bruce, that you update your will. You should be looking at your will every year. I mean, that's really the gold standard, or at least when circumstances change.
And yeah, have the guts to do it and have the guts to face up to this issue, because there's so many considerations when writing the will. What do we need to understand about the complexity of overseas assets and domestic assets? And more people are investing, and they may be thinking that they're geniuses and they can do it themselves, and they can go offshore and they can do it themselves. They may want to use advisors and get some decent advice on it and do it as cleanly as possible. But when it comes to drawing up a will and multiple wills and understanding multiple jurisdictional rules, there is so much that you have to consider.
Yeah, Bruce. I mean, I'll try and keep it short because we don't have, I know we've only got a couple of hours together, me and you, so I won't go too much detail. So the first principle is that in theory, your South African will can regulate your foreign estates. So you could say in your South African will, this applies to all my assets in South Africa and offshore. So that's fine in theory. In practice, it doesn't work well at all because there's a couple of problems. Number one, your local will, the original copy has to go to the master in South Africa. Now, the overseas authorities also want an original will. So you'll find that unless you've got multiple originals, which is very rare, your original will go to the master and the authorities overseas will have to wait to get that back before they can start winding up. That's the first problem. The second problem, of course, is conflict of laws. So we got a set of laws in South Africa. There's a different set of laws overseas. The European countries, particularly those that fell under Napoleon in the good old days, apply forced heirship, which means irrespective of what your will says, your assets will go to your spouse and children in a fixed percentage. So you could have a South African will leaving your assets to your children, and the French authorities will say, we won't comply with that because you've cut out your spouse and we won't recognize that. And then, of course, the third problem is the legal differences, the conflict of laws, where South African law might require certain requirements for a will to be valid. The overseas authorities might have different requirements. In other words, we need 2 witnesses to witness a will, overseas authorities might have different requirements, and you could have a classic conflict of laws there. So though in theory, the South African will could do the job, unless it's a very small asset overseas, unless it's just a bank account or a simple unit trust, the general advice is to have separate wills overseas to regulate those different jurisdictions. Or even simpler, Bruce, as we always like to say at the insurance company level, if you can wrap your overseas assets into an endowment wrapper with a South African insurer, then the endowment wrapper allows you to nominate a beneficiary, and when you die, those assets will pay straight to the beneficiary. You bypass the whole problem of a foreign will, of foreign laws, of foreign conflict of laws. And then that last word, which I love throwing in, of probate, which is the whole business of actually winding up an offshore estate, which in itself is a separate discussion on costs, on finding foreign executors. But if you've got a foreign endowment policy, that whole problem goes away. You nominate your beneficiary, the cash or the proceeds pays out of the policy direct to your beneficiary.
What about using donations more effectively in terms of reducing tax? Whether those donations go to beneficiaries who are named in your will or whether those beneficiaries are the SPCA, whatever the case might be, the use of donations while you're alive to better structure your affairs.
Yeah, Bruce. So in terms of our Income Tax Act, you pay donations tax at the rate of 20% or 25% on assets that you donate, but you get an annual exemption of 100,000 Rand a year. So you're allowed to donate up to 100,000 Rand a year to anyone you want to, free of donations tax. And I agree with you, that's a very good tax planning and estate planning vehicle to use, where every year you should be getting rid of 100,000 Rand out of your estate. Now, the question everyone's going to ask is, well, who do we give the money to? I mean, you could obviously donate it to a charity, but then, of course, it's gone. If you want to get rid of it and yet still keep it, the classic structure is to create a trust, donate 100,000 Rand every year to a trust, and let the trust then take out an investment with that money, because then the money's left your estate, it can grow in the trust's hands, and you don't have to worry about any estate duty on that assets anymore. And if the trust invests efficiently, you can even minimize your income tax as well. So using donations is a very important part of planning. You can also donate between spouses. So if you're lucky enough to have a spouse, Bruce, you can use them as a tax planning vehicle, and you can donate assets to them because there's no donations tax on donations between spouses.
Are there not sort of limitations on the extent of donations that you can make available to your spouse?
No, you can actually give your spouse unlimited amounts of money without donations tax, but there is a little catch, because in terms of the income tax anti-avoidance provisions, if you're donating assets to your spouse for you to avoid income tax, then SARS can actually ignore that transfer. So I'll give you a simple example. Let's assume the wife is the richer party and she wants to invest R1 million, but she's wealthier, she's got a higher income tax rate than her husband. So she gives him the R1 million because there's no donations tax between spouses, lets him invest it because his tax will be lower. What Section 7 of the Income Tax Act says is, because that transfer was done to avoid income tax, SARS will actually ignore the transfer and will still tax her on the income from that investment. So you can donate assets to spouses, but you've got to be careful that you're not seen to do it to avoid income tax, because else you'll be caught in the anti-avoidance rules. You can do it to avoid estate duty or to do for estate planning, but you can't do it as an income tax avoidance scheme, or else the anti-avoidance rules will catch you.
And you've also got to make, I suppose, pretty certain that your spouse feels the same way about you as you do about them. And I guess in many cases, the reason why some estates end up in such a mess is back to your friend in hospital with spouse 1, spouse 2, girlfriend 3, and nurse 4. So some of these things are never as simple as they appear on the surface.
Exactly, Bruce. I mean, we always say, if you are using your spouse as a tax planning vehicle or an estate planning vehicle, divorce will become very inconvenient. And we see that very often, that transfer assets to the spouse, that there's a divorce, and then the spouse says, oh, no, I didn't really give them the assets. I was just meant to do it as a tax planning structure. And then the courts have got no tolerance for that or no sympathy for that, I can tell you. Once you've donated the asset, it's gone. just make sure your spouse stays, even if the asset's gone. I agree.
And I've asked you this question before, but big three things that we should really be aware of when we are looking at this, and I like the word smorgasbord, so let's use it again. When we look at the smorgasbord of options open to people, especially people with a bit of money, with potentially with assets in different parts of the world, what are the big three things that you need to be considering as you do your planning?
So, Bruce, yeah, I mean, the first thing is for South Africans, it's very difficult for them to do a will. I don't know why. I think they worry if they do a will, they're going to die, or they don't like thinking about death. But I mean, 70% of South Africans die without a will. So it's very important for South Africans that you actually get down and you do this will. I can tell you all the banks, all the trust companies will help you. You can do a simple will. It's not that difficult. But get that will done. But then when you do the will, and this is the problem, and I always say I love seeing clients' wills, because when you look at a client's will, you actually see into the soul of that client. Isn't that nice and poetic for a lawyer? But
It
a client
is.
is access to their soul, because when you look at their will, you see what really makes that client tick and how they think about people. But you've got to say to a client, when you do your will, you must be honest. You've got to know at what age your children are able to handle money. You've got to know how much money to leave to your children and your spouse, how to protect them, what kind of assets you should leave to who. So that's the first thing. Do your will and be honest with yourself when you're doing that will. Secondly, you've got to think about tax. I mean, when you're doing any kind of estate plan, you've got to think about tax. You've got to think about estate duties. So just two simple rules: that your first 3.5 million rand in your estate is free of estate duty. If you're the second dying spouse, it might go up to 7 million, but you should use that rebate to its maximum. And the other plan is whatever you bequeath to a spouse is free of estate duty. That's the well-known paragraph 4Q of the Estate Duty Act. But again, you can leave everything to your spouse, but then of course other people are cut out of their estate. So you've got to try and link up estate planning with estate duty minimization. And then the third thing, Bruce, it's so important, is liquidity in a deceased estate. You know, not a lot of clients die with R1 million cash in their bank account, so the estate gets wound up. But people forget the actual cash needs in their estate when they die. I mean, you've got to pay executors' fees, you've got to pay taxes, you've got to pay estate duties, you've got to pay all your debts, all your overdrafts, all your liabilities. There's a big cash need in an estate when you die. And I mean, obviously the simplest way to fill that need is to have a life policy, but you've got to be quite clear. You've got to think very carefully who that life policy pays to. You might well need to pay that policy into your estate to provide the cash, but then you've got to think about executors charging fees on that. And you've got to plan carefully that there's enough cash in your estate when you die. And that's what we call a liquidity analysis. You should sit with your financial advisor or your estate planning advisor, and you should sit and look at your liquidity, your tax problems, how much cash you need in your estate. As I always say to clients, you know, you probably can't afford to die. You just haven't got enough cash in your estate. Can you actually afford to die? Which is a big test to be able to get through and to look at.
For many South Africans, they'll say, well, that's my insurance policy. I can't afford to die, so I won't. And I like your statistic of 70% of South Africans die without a will. There's only one greater certainty than that, is that 100% of South Africans will die. And I suppose ultimately it is therefore the huge burden of responsibility of you when you're alive to make some decent choices so that everything you worked for goes to where you wanted it to go to, Harry, and the vast majority of what you've worked for ends up where you would have liked it to go. And yeah, the taxman will get their bit, but you don't necessarily want to give them too much of an advantage over your beneficiaries.
Yeah, exactly. I mean, it's all very well doing a very complex tax plan and everything goes into trusts and your kids don't get anything. But ultimately, as you say, Bruce, I mean, the point of a tax plan is A, to minimize tax and estate duty, but B, to make sure the right assets go to the right people. And I mean, again, I've seen so many cases where dad plans so carefully all the assets going to trust and there's no taxes paid, which is great. But then the family can't get the money out of the trust because they're fighting with the trustees and they're fighting amongst themselves. And ultimately, I always say, you as a client, when you go upstairs, you want to look down and see your family fighting and your kids fighting and your spouse and kids fighting and no one getting any of your hard-earned money. So it's all very well doing tax planning and estate planning, but really, as you just said, Bruce, you want to make sure your assets go to the right people and the right people get the right assets. It's no good leaving your dental practice to your son who's never going to be a dentist and hates dentistry. You've got to make sure you plan around that. Make sure the right people get the right assets. And again, you can leave everything to your spouse and then you won't pay any estate duty. But can your spouse handle such a big estate and handle such a big amount of money? It might be better to pay some estate duty and pay only some assets to the spouse and the rest of the assets to other family members who can handle it better. So it's not just a tax issue. Tax is one of the issues, but it's very much, as you again say, Bruce, I'm going to quote you, a smorgasbord of issues. Look at tax, look at estate planning, look at your family, look at who you want to get what, and make sure the right assets go there.
Harry Joffe, the head of legal services at Discovery. Thank you.
Thank you, Bruce.